The global economy is facing a potentially catastrophic shift, as the Federal Reserve has placed a damper on market expectations. If you were hoping that interest rates would drop to near zero levels, it's time to adjust your outlook. Despite the Federal Reserve officially cutting interest rates by 25 basis points, the stock market is not responding as many anticipated instead of the expected rally. We're witnessing a significant downturn, stocks and treasuries are tumbling, and the US dollar has surged to its highest levels since 2022. This scenario isn't playing out as anyone expected, and there's a growing sense of unease. The reason for the continued pessimism is that Federal Reserve Chairman Jerome Powell recently predicted that rate cuts would be fewer in 2025 than previously anticipated. Inflation remains a persistent issue despite what seems like a robust economy on paper. The Federal Reserve's projections suggest that they have little room to maneuver, and it's becoming clear that interest rates may remain elevated for a longer period than previously expected. Currently, interest rates are falling from 5.5% to approximately 4.25%. For many, this drop signals the possibility of further cuts, potentially down to zero, as seen in previous cycles. However, there are some critical considerations that make this outlook less optimistic. For starters, the Consumer Price Index (CPI) inflation rate for November stands at 2.7%. While this is a decrease, it still far exceeds the Fed's target of 2% core inflation, which excludes food. And energy sits at 3.3%, indicating that prices for goods and services, such as housing and healthcare, are still rising rapidly. The Federal Reserve focuses heavily on core inflation when setting monetary policy, and this persistent increase in prices is a key reason why interest rates may stay higher for longer. As interest rates continue to stay elevated, the cost of borrowing will remain high, which is having ripple effects across all sectors. Risk assets such as stocks, gold, and even wheat prices are all declining because higher real interest rates make them less appealing. The Federal Reserve's post-FOMC meeting statement suggests that they are revising their outlook on future rate cuts, with fewer expected in 2025 than previously believed. The latest projections suggest that interest rates will only fall to around 3.9% by 2025, a substantial increase from earlier expectations. For investors, this presents a challenging environment. Unlike previous cycles where the Fed cut rates rapidly, this time the adjustments will be slower and more incremental. Instead of large 50 basis point cuts, the market can expect small 25 basis point decreases with very little room for larger reductions. One of the significant challenges for the United States economy is its mounting debt. With a projected increase in deficit spending and no clear path toward fiscal responsibility, this debt burden will only grow. Former President Donald Trump's return to office in 2025, coupled with his ambitious plans to reduce taxes and revitalize American manufacturing, will exacerbate the problem, as Trump aims to bring more industries back to the U.S. ranging from semiconductors to automobiles. He will have to do so in the face of rising interest rates. Higher rates will complicate his efforts to revitalize American industry, as borrowing costs for businesses and the government will remain elevated. The U.S. is facing a record high current account deficit, which hit $310 billion in the third quarter of this year. The nation continues to borrow money to fund its budget deficit, without a surplus to balance the books. As long as this trend persists, the government will be forced to borrow more money, which will only drive up debt levels further. This situation is further complicated by the Federal Reserve's decision to maintain higher interest rates, which will only increase borrowing costs for the U.S. government, further exacerbating the country's fiscal challenges. Despite low unemployment rates, the Peterson Foundation predicts that U.S. deficits will continue to rise, potentially averaging 6.3% of GDP between now and 2034. This doesn't account for the potential spike in spending that could occur under Trump's leadership, which could push the deficit to 7% or even 8% of GDP. Trump's proposed global trade war will only increase U.S. deficit spending dramatically. The Federal Reserve focuses heavily on core inflation when setting monetary policy, and this persistent increase in prices is a key reason why interest rates may stay higher for longer. As interest rates continue to stay elevated, the cost of borrowing will remain high, which is having ripple effects across all sectors. Risk assets such as stocks, gold, and even wheat prices are all declining because higher real interest rates make them less appealing. Ambitious projects. In November, the U.S. Treasury faced a significant challenge, with the 3-month T-bill averaging around 4.6%, while the 10-year note hovered at 4.4%. This shows that the interest rates for both short-term and long-term borrowing are high, and the Federal Reserve's refusal to reduce rates further is only adding upward pressure, with more borrowing on the horizon, especially as Trump seeks to finance his plans for economic revitalization. Long-term rates will remain stubbornly high. If this borrowed money is wasted or poorly allocated, it could exacerbate the existing inflation problems, potentially creating a vicious cycle where rising debt leads to higher inflation, which then forces the Fed to keep rates high for even longer. The Fed, under Powell, has made it clear that it will maintain its independence, despite calls from Trump and others for faster rate cuts. Powell reiterated that the Fed's mandate is to achieve both maximum employment and inflation at 2% in the long term. Until this goal is met, the Fed is unlikely to make significant cuts in interest rates. The markets are already reacting to the Fed's stance. Stocks, both in the U.S. and globally, have been struggling. The S&P 500 experienced its worst day since March 2022, losing nearly 3% in a single day. The impact of higher interest rates is beginning to take its toll on businesses, especially small and medium-sized enterprises. These companies will face higher borrowing costs, leading to reduced investment, slower growth, and potential job cuts. For individuals, this means that mortgages, credit cards, and other forms of debt will become more expensive, potentially leading to a slowdown in consumer spending. The global economy is also feeling the effects of the U.S. Federal Reserve's policies. Many countries rely on dollar-denominated debt, and as the U.S. dollar strengthens, borrowing costs for these countries rise. Emerging markets, in particular, are feeling the pinch. As the U.S. dollar strengthens, foreign equities are losing value at a faster rate than U.S. stocks. The dollar's effect is being felt across the world. And if you're investing in international markets, this is something to keep in mind. The U.S. dollar has been strengthening steadily, and it is on track to reach levels not seen since 2022. This might sound like good news for the U.S., but the rising value of the dollar is causing significant problems for other economies. As the dollar strengthens, it makes U.S. goods and services more expensive for foreign buyers, which can hurt U.S. exports. It also increases the burden on countries that rely on dollar-denominated debt, making it more difficult for them to service their loans. The rising dollar is also causing a slowdown in foreign equity markets. If you're investing in global stocks, you're likely seeing losses as a result of this phenomenon. This is particularly problematic for emerging markets, where the dollar's strength is causing major financial strain. Looking ahead, it's clear that the U.S. is facing a difficult economic future. The Federal Reserve's decision to maintain high interest rates, coupled with Trump's ambitious plans for reindustrialization, could lead to a challenging few years. The government will continue to borrow to finance its deficit, and the rising cost of borrowing will only add to the country's economic woes. The global economy will also feel the effects of these policies, with rising inflation, slowing growth, and increased financial strain for many countries. In the coming years, it will be crucial for investors, businesses, and individuals to adjust their expectations. The days of easy money are over, and we are entering a period of higher interest rates, rising inflation, and increased government borrowing. How the U.S. navigates these challenges will have far reaching consequences for both the domestic and global economies as the situation develops. It will be important to stay informed and adapt to the changing economic landscape.